Black and white consulting. No shades of gray.
Our vision concerning Siddiqui Capital is very straightforward, and it begins with asking ourselves three simple questions. Firstly, where are we right now? As we can see, Siddiqui Capital is an experienced venture capital firm with a primary focus on the telecommunications industry, and it is definitely important to focus on their strengths and what made them successful in the first place. Now, if we ask ourselves, where do you want to go? We can see that Siddiqui wants to gain exposure to Singapore's leading-edge telecom market in order to test and potentially leverage the value of their 4G compatible software house. And we believe the way you're going to get there is by acquiring a controlling stake in Singapore's Mobile One telecom company through a leveraged buyout. And since you are indeed a venture capital firm, it is important to appropriately plan for an exit strategy through a possible IPO. When analyzing the Singapore telecommunications industry, an issue that definitely plays in our favor is the presence of a strong government leadership and support. As one of our most important stakeholders, the IDA has recently lifted all restrictions on direct and indirect foreign ownership within the country's telecom sector. Not only do they encourage a richly competitive market, but they are also behind Singapore's Intelligent Nation 2015 master plan, to which we will surely contribute. Being such an advanced and competition-filled industry, some might think that the market is mature and relatively saturated. But a point that certainly mitigates this is the fact that the Singapore scene is so focused on progressive trends and emerging technologies that there will always be room for growth, especially with such leading-edge software for the 4G network. Finally, taking a look at the competitive playing field, we can position ourselves in relation to our two main competitors, StarHub and Singtel, both in terms of level of technology and market share. Essentially, by acquiring M1 and integrating the software house with them, this will create a zone of best fit of where we would like to take the company. As the 4G network expands and we increase our technological offerings, not only will we attract a greater market share, but inevitably place ourselves in a more competitive position.
So as you can see, guys, the situation definitely looks bright, but we can't get a full picture without getting some financial backup. Now, can you bring us through some alternative approaches? And through your research, what would be the best option to take?
First, we narrow down our acquisition alternatives. The options we have are straightforward. Since your major operations do not relate to the telecom industry, you seek not unite your core activities with M1's. Hence, the potential takeover will neither be a merger, an acquisition of assets, or a consolidation of operations. Simply, since you're an outside investor, you seek to make a buyout, and we recommend that it be a levered one in order to satisfy the investment requirement of RSI, which is to earn a standard private equity return of at least 20%. We start the takeover valuation by finding the fair value of M1. We choose a discounted cash flow approach given the stable nature of M1's finances. First, the DCF uses several assumptions as seen above. We use conservative drivers such as a 2% growth rate, and we model the other values using management's estimates and historical ratios. We calculate free cash flow to the firm and discount it using the WACC. We get the sum and deduct net debt to get the intrinsic equity value, which corresponds to 2.14 Singapore dollar per share, while the current market price is 1.71. This undervaluation could be due to a lack of leadership and vision from M1's management. In any case, it makes M1 a perfect takeover target. Next, we reconcile the acquisition cost. To make sure current shareholders will tender their shares, you should offer them a 25% premium above market price. We get the cost of the transaction, to which we add a standard 1% M&A advisory fee, which you should receive as part of your services to RSI. We now have the buyout cost. Next, we need to finance a takeover. Since you're not a public company, you cannot use shares as currency. The only option you have is equity or debt financing. We recommend a combination of both, but with a much higher debt portion. Indeed, significant leverage is needed to amplify the return on equity of RSI's investment. We now start the post-LBO model. Two driving factors are the initial equity investment and the borrowing cost. The valuation process is similar to a DCF, but our discount rates are dynamic given the changing capital structure. Although the firm becomes highly levered, EBITDA is high and stable enough to service our debt and capital expenditures. As such, we can safely value the deal by disregarding the cost of financial distress. With the knowledge that the LBO is the optimal financing approach, we now turn to the exit strategy. A hassle-free method would be to sell to a competing telecom firm, but the IDA might interfere. We could also sell to external investors, but there is no assurance that there will be any when needed. Hence, the preferred exit strategy is the IPO, which is highly visible and gives great pride to the VC behind the deal, but with the only drawback of having a high underwriting cost. We can model the IPO exit by using the terminal value of the firm, make capital structure adjustments, and deduct investment banking fees to get the net proceeds. We now have every piece of the puzzle to calculate the net present value and internal rate of return. Lastly, we need to model the ownership structure. RSI is probably concerned with the return on an investment. They might not share your view that the merits of M1's takeover are beyond the numbers. Hence, to make sure they finance the deal, their internal rate of return should be at least above 20%. To find the ownership structure, we must generate sensitivity analyses to see how RSI's IRR behave by tweaking the initial investment and borrowing costs under three different ownership scenarios: 50-50, 30-70, and 10-90 ownership division. Of course, the higher RSI's claim on cash flow, the higher its IRR. It is only under the 10-90 structure that the deal has a high likelihood to make sense for RSI. Hence, this is the optimal ownership structure. Finally, although you believe that standalone valuation for this deal is secondary, you still stand to gain considerably. For example, if the initial investment were to be 350 million Singapore dollars, your NPV would be 66.37 million Singapore dollars, which is very reasonable considering you have not invested capital.
Obviously, during the acquisition, M1 will face certain insecurities and risk losing employees' confidence. In order to avoid this, the first thing we can do to assure a successful buyout is keeping the communication open. It will be important for all employees to have a clear understanding of the situation and not feel like their jobs are at risk. Keeping the communication lines open will also involve targeting the main employees in the company who motivate and will influence others to be open and positive about the buyout. After a 6-month period, it would also be very beneficial to provide all employees with a small bonus to encourage positive connotation with M1's integration with Siddiqui Capital's 4G compatible software suite. Also, it is important to indicate to all employees within M1 that there will be many opportunities for salary growth, promotion, and career development. Next, it will also be important to reinstate job expectations and make employees aware that they have excellent guidance and supervision. Also, to give them clear expectations of the responsibilities in the workplace that they will have so they feel like they are making a significant contribution to M1's growth. Finally, taking a look at the current M1's management structure, it will be vital to reinstate Karine Coy to her CFO position and appoint a dynamic and successful individual who understands the telecommunications industry very well to CEO. A prime example would be an individual like Leon Kang Tai, who has experience with the IDA and has the same vision as M1 for the future in telecommunications.
Well, last of all, I've got some really interesting marketing ideas. As we said, we do want to grow M1, and it's also important that we know how, Siddiqui's going to be able to sell their 4G software, globally later on. So let me just show you what I've put together here. Just check it out. Okay, so first up, what's the story with the M1 brand right now? As we know, M1 has really built their reputation around the release of 3G. This was a very successful strategy for the company, and they've become the second largest mobile operator of Singapore in terms of market share. We should continue to build the M1 brand around the idea of being a technology leader. So how do we ensure this leader status? We need to partner with a 4G smartphone maker so we have an exclusive offering for our customers. And how exactly are we going to introduce Singapore to 4G? We should have a teaser campaign followed up with mass marketing, and of course we want to have nationwide coverage. For the teaser campaign, a cool thing to use would be green graffiti, which is an eco-friendly way to place advertising in creative, unusual places around the city. This will get people scratching their heads and let them know that big news about 4G is coming soon. Then, Singapore will be blanketed with our mass marketing campaign. A cool part of the campaign will be a contest in which people must accomplish goals using their 4G smartphones. Siddiqui Capital and RSI will have no problem selling their 4G software worldwide once they own M1. So in summary, we need to position M1 as the 4G leader and take measures to grow the brand. Then the 4G software can be sold on a global scale.